I've just hit record, so we'll start a recording. So what we'll deal with today in the next hour, have you got a whole hour to spare?
I do, yeah.
Yep. So in the next hour, we'll basically cover off, like I said, we're involved in court cases and things where it's always difficult to work these things out, but where we get to the point where we have to come up with an answer. And so what we're going to take you through today is the pragmatic approach that we take, whether it's for any situation where we're looking at a set of numbers, budgets, situations, plans. When we look at all that, what we need to do is put ourselves in the shoes of a rational investor that had good knowledge and all that information and try to predict what would a rational investor do. And that's all a business valuation is. It's not saying what might someone pay, or it's about what would a rational person with enough information, enough knowledge, what would they decide? Because that's what a valuation is. It doesn't mean that you wouldn't sell the business or raise capital much higher than that or much lower. It just means that's what the real value actually is from that perspective. So the job as someone raising capital or selling their business is to get a price much higher than value. It's like when you're selling a house and you get a property valuation, they say it's worth $600,000. You hope to get more than that. You don't sell it for the valuation. You hope to get more. And it's the same, but at the same time, you might only sell it for $500,000 because at that point in time, there's not enough buyers in the market or whatever. And so what we're doing is trying to predict if the right person had all the information, what would they say it's worth, right? And then that's your benchmark. Now, which is in this case here, we have to use a lot of hypotheticals and assumptions. Your job, as I've explained in my email to you earlier, your job is to then sell those assumptions and variables to the right people. So our job is to quantify with a certain set of assumptions and variables and methods what would the value be mathematically, so that we build a model that if to put the right variables in, the valuation works. It's your job to sell to people that they are the right variables. Okay, so it's any early stage that raises capital or sells, they have got a really good salesperson internally. So it's one thing to get it valued, it's another thing to convince people that the variables in that valuation are accurate. And that's the real trick. So we build models that we can build a valuation model under any variables you can imagine, but we're not going to stand behind the variables as a valuer, we're going to stand behind the model. And it's up to the person that's provided the variables to articulate and convince people that they are accurate.
And that's usually the founder?
Yep. Or whoever. You might employ somebody else to do that. But that's the separation between someone that raises capital and is out there doing the pitching and what a business valuer does. A business valuer doesn't go out and necessarily do the pitching for you. Sure, that can be an extra service that can be part of it, but that's not the job of the valuation report. The valuation report is to say we'll gather all the variables we can, with a bit of interaction, make sure they're as reasonable as possible, quantify if those variables were to be believed by the right person, what would they think the business would be worth based on those variables, and then your job is to go out and sell to people that those variables are accurate.
Right.
All right. And obviously, with a pre-money startup, the more traction you get, the more and more you get believed about things. So you might find you get a valuation report that no one believes at the moment, but then you go and pick up 10, 15, 20, 50, 100 customers that start paying you, and you're accelerating at a good incline. Then you might have people reading the valuation, and those numbers that you start getting might be just in line with what you originally predicted and would use for the valuation report. But the valuation doesn't change, but people's perceptions of its accuracy do as they start believing your assumptions and variables. Right. So this is not an exact science of, Trevor, gather all the information, here's our business plan, just tell me what it's worth, because there is no answer to that. It's all about what someone would perceive it to be worth. We are just trying to predict what that knowledgeable person would do if they were to believe the variables. Whether or not they believe the variables is really up to somebody else to make sure that they do. And like I said, sometimes that just takes time for the business to prove its worth. Okay, so that's contextually where a valuer sits into all this. So a lot of people say, give me a valuation so I can convince people that it's worth investing. And again, that's not what a valuer does. A valuer hypothetically values the business on the variables, and yes, we'll work with you to create those variables if we need to, but we're not saying to everybody those variables are, those forecasts are definitely going to happen. We're just saying if they do happen, this is what it should be worth today in today's dollars. Okay, so it's really, really important. So once you understand that context of all that, it sort of takes the pressure off a bit, because you're not seeking to know the value. You're seeking to understand the levers and dials that make the business worth something, and then working internally to work out how do you explain and convince people that those lever and dials are going to actually happen in terms of forecasts. Okay, and you'll find a lot of people won't be honest with you about what they actually do. You'll find some business valuers we know will go out and say, basically, we'll create a report that will convince people to invest in your business, and we'll even make sure of it, and blah, blah, blah. And what happens, they do the valuation, and then you never hear from them again. We're more honest with that. We try to explain where we fit into the whole context of the thing. And then at the end of the day, if the valuation is a bad valuation, you need to know that. Because what we're doing is we're predicting that if someone with some serious dollars was considering investing in your business, and assuming they had a decent business valuer by their side, what we're actually doing is we're now simulating what that valuer will tell that investor. So it's no good if we all sugarcoat it and say, well, this is worth $1 billion, if we know that a serious investor is going to get advice saying it's worth 5,000, because you're only kidding yourself. Right. If it's worth 5,000, you need to know it's only worth 5,000, and then what you've got to do is be able to work on your sales skills to convince somebody otherwise. And what I often say with people, people selling an all business, not necessarily an early stage startup, but you might be selling anything, could be a cafe. What you're trying to convince somebody is that the future is bigger than the current, knowing that usually if the buyer went and had a good advisor and looked at the current figures, they would probably say it's worth a lot less than they're asking for it. And what you're often trying to do is trying to pre-arm that buyer or investor that we know that your accountant or valuer is going to say it's not worth much, but they're not going to take into account X, Y, Z that's changing in the future. So sometimes it's about, if you know that the valuation outcome is going to be low, if an independent third-party valuer did it without being, inspired or energized by the future of the business, they're just cold hard looking at the numbers. You need to pre-warn that investor in your initial conversation with them that so that when they go and see their advisor and they get told it's not worth a lot, they go, yeah, I know that you were going to say that, but you're not taking into account X, Y, Z about the growth and blah blah blah. So sometimes it's about preempting to the investor that yes, on paper your advisors are probably going to say it's not worth a lot. But we know they're going to say that because they're not taking into account X, Y, Z. And all that actually happens, and when they go and see their advisors and people they trust, they then take their advice with a grain of salt. And they start knowing that they're going to get advice probably not to invest. They're probably still going to do it anyway, as opposed to going seeing their advisor and get a big shock that, you're saying it's not worth much. Right,
Yep.
Most normal accountants you'll see will say, if you think about how most accountants, I'll call them lazy accountants, how they value a business, is they take the last 3 years' profit and they average it. So they say, well, you made 50,000, 150, and 100. The average across those is 100,000 profit. And they model, so they say they therefore say your future profit will always be the average, 100,000, which is rubbish. But that's just the way they do it. They only look backwards. They don't actually think about what the future is going to hold. They just take the average and they multiply that by some random number, which is usually around about 3. And they say therefore your business is worth 300,000. Now, the problem with that is that they don't take into account anything to do with the future. They don't even take into account that the most recent year is probably more reliable than the 2 years before it. And they certainly don't take into account the business plan and what's happening to implement that business plan to make the future brighter than the past. So if you take your business, any startup business, to any lazy valuer, they're just going to say, well, where's your history? At best, they might say, well, what are all your costs to date? Maybe someone would buy your business just so they don't have to expend those costs themselves. They might pay for those costs and effectively give themselves a shortcut. I think that works with a cafe where you say, your cafe is not profitable, but I was going to start a cafe anyway, and you spent 200,000 on a fit out, and I was going to spend about 200,000 on a fit out in the same kind of area. How about I just pay for your fit out, and that way I can start trading tomorrow? No goodwill, nothing, but I'll do that. So that works in that industry. If you're going to buy a restaurant in that area and fit out yourself anyway, why not just pay someone a little premium to get started today? Uh,
Mhm.
so the assumption is, in your case, that someone was going to build the exact same company with the exact same technology and the exact same customers and business plan. They were going to do it, and it was going to take them a year, and they might as well just buy yours and have it tomorrow. No one's thinking that they're trying to do what you're going to do or what you're doing or have done, because you're
Mhm.
unique. Every business in your situation is unique. No one's coming saying, "Well, I was going to do that anyway." You've cut some corners. Maybe there's some issues where you might have built some technology or process that others might find useful. Certainly, if it's a larger company and you've automated something that's very laborious to them, at the moment they might pay you to take on that technology. So you might automate something in around how emails are captured into some kind of document management system or online hub, and they might have had everything but that in their current technology or software, and they might pay you your replacement of cost that has taken you to develop that part.
Yeah.
Or they might just try to reverse engineer and try to do it cheaper than you've done anyway. Um, so it's one of those things that you make a lot of mistakes when you're building something from scratch. If you reverse engineer someone else's, you don't necessarily have to make all the mistakes. So you'd probably back yourself to internally develop it rather than buy it. Come out
Uh-huh.
cheaper. So there's a lot of issues, yeah, but yeah, you'll find lazy accountants going, we always value it based on the past. If you're going to give me just no past and give me a budget, that's not reliable enough for me. Who can value that? Sorry, can't value it. And we look at it and go, well, again, because we're often the last port of call, we have to value it on some basis. We use hypotheticals and we value those hypotheticals, and it comes down to whether the readers of the report believe the hypotheticals will determine whether they believe the valuation. But all we can guarantee is the valuation methods are solid and can be backed up if the variables are believable. Okay, so we're sort of we have the models, we build the models and the tools, you provide the variables with consultation with us, and then we provide a report that works if the variables are believed. So to give you a rough idea, so what is the outcome of what we do? So what I'm showing you here, can you see a report on your screen? Hang on, let me click a button, sorry. Now, you should be seeing
Yeah.
limited business valuation. Okay, so this is the output. So after all the hours and hours and hours of interaction and doing your numbers and thinking about stuff, and this is what you get typically. So this is another early stage business. This was actually a business that had manufactured a prototype physical one and had patented that all around the world and had done nothing with it yet, but had plans. So not too dissimilar to what you're doing. So this is the contents page. This is roughly the kind of stuff that you get in the reports. We have an executive summary. We have commentary, details about the business, what information we've used. We go into great lengths about the assumptions we've taken, and then typically we give scenarios. So we don't just say here is the scenario of the future forecast. Often we say, well, here are 4 scenarios, so we can show sensitivity to certain variables. So we'll have a combination of working out what are the key sensitive variables, and often in your kind of business, it's the take-up, things around take-up or pricing. Not so much cost in your industry, but we'll look at what are those key variables and then sort of notch them up or down around the anticipated to see how does that change the outcome. So it's important in these things we generally show a range of outcomes rather than just saying a definitive amount. And to be honest, that from a reader of a report, it looks much more believable because we're not saying that there's a definite outcome. All we're trying to do is give the reader the tools to let them work out what they believe and let them work out what they'll therefore pay. And we're just trying to assist them in that thought process themselves. Obviously trying to guide them down a path, but not trying to make them feel like they're being painted into a corner or being tried to we don't want them thinking that we, the independent valuer, are doing a song and a dance to convince them of something. That's your job later. They need to be able to read our report, show it to their own advisors, and their own advisors go, you know what, that's pretty fair. Then it's your job to convince them or someone else's job to convince them the variables are accurate enough to rely upon, and therefore the valuation should be sound at whichever scenario they think is the most reasonable. So we basically in the executive summary, we describe a bit about the business. Obviously, I've taken the names out here, and then we show the valuation outcomes at each scenario. So in this particular business, we think it's worth the initial assumptions that the founders gave to us, that we helped them build about $8 million right here and now. Scenario two, where we basically reduced the price of the unit they were selling, and it was important for the founder to see this. That made a huge difference, changing nothing but the unit price, and not by a lot either, by the way. So that's basically the retail selling price. Scenario three
Yeah.
was reducing basically the take-up rate, but keeping the price and everything the same. Also reduced the price considerably. On the flip side, everything else the same, but finding a way to reduce the per unit manufacturing costs made a huge difference and actually increased the valuation to 12 million under our model. So from that, the founder was able to go back and start making sure he could start convincing people that the initial assumptions are fairly accurate, and also gave him some ammunition to go and look at his manufacturing process to see if he could make it more efficient.
Yeah.
Right, so this is not just a set and forget, get a valuation to see the outcome. It's also, if used properly, is a sort of a learning process for the founders to go and revisit the business model, or to go and work out what are the things within the business that are the most sensitive to the valuation, and therefore probably the things you should be working on and spending, prioritizing your time on. It's the kind of thing that you would do typically if we're doing business planning from someone from the outset. Maybe they don't have a business plan at all, but just a few ideas. This is the kind of stuff we'd be dealing with as part of the business plan, not necessarily valuing it, but they're the same issues.
Yeah.
It's always the same kind of thing.
In the scenarios that you've put forward here, which of the business models have you used? And I saw in the previous page that you had some asset-based ones, some income-based ones.
Yep.
And in the scenarios that you've put over here, is there one particularly being chosen?
All of these, you can see that there's an underlying heading above these scenarios here. It says present value discounted cash flows. So we explain later on the report that we can't use those other methods of valuation. We don't think they're appropriate. So we start every valuation open-minded. We think, okay, we've got almost infinite numbers of ways of looking at this business in terms of the valuation process and methods and best practice. And we look at it and we say, again, put ourselves in the shoes. If we were investing in this business, or we had a client investing in it, and we were knowledgeable, we knew what we were doing, and we had enough information, how would we look at it? We're just trying to put ourselves in the shoes of that investor and their advisors. So we're looking at, future maintainable earnings, which is all about looking at past earnings and working at what's maintainable, is not relevant here. Net asset backing is not really, when your assets are effectively sunk costs, is not really worth valuing, unless, again, we could predict that someone was going to start up the exact same business or going to go through the same technology development process, exactly the same, and would purely buy what you've got now to save that time. And it's just too hard and too fickle to start predicting that's going to happen, unless you had a particular situation where you'd been talking to some competitors or a large company and that actually talked about taking up some of your technology just to save them time. Then that would definitely be an alternative method we would look at least in your discussions with them. You'd be saying, well, you're potentially going to them part of the sales process of, we think it would take you, $400,000 in labour to replicate what we've done. We'll sell it to you for $300,000. Can we do a deal? That's not necessarily about a valuation. That's more of a negotiation tactic, pulling out your production costs and trying to convince them that they're going to save those costs by just buying your technology now. There's not enough in most startups to be even looking at that kind of stuff. Sure, we can do it as an extra process, but to me, it's not going to be useful in valuing the business as it is now in most occasions. So we're going back to basically discounted cash flows. And then we spend the rest of the report basically substantiating those valuation outcomes here on the executive summary. So we talk about what are the methods and assumptions, where do the assumptions change between each of the four scenarios, and then if I scroll down, way down into the calculations, then you can see here we get pretty thick and heavy into actual calculations, which I'll show you in a second in Excel. So we go through and we basically, again, it allows us, because what you'll often find is you'll find a gun-ho investment, capital raising guru. He's got shiny shoes and white teeth, and he comes in and goes, you know what, I can pitch your business to anybody, and looking at your business, I think we get $5 million for it. And he walks into a room and says, this is what a great, exciting idea, isn't everybody energized and hoo-ha and hallelujah? And then everyone's excited. Then they go to an accountant and they go, but where's the value? Why do they think it's worth that money? And what we're doing here is to say, when an accountant sees our report, they go, right, they sink their teeth into it and they can't fault the mathematics. And suddenly you're a more credible business when you've got this kind of report compared to the one built upon excitement of the pitch. Because you've got to remember, at the end of the day, if you're asking for a sizable amount, you're going to have decent advisors on the other side. They're going to want to know the nuts and bolts.
Hmm.
So it's one thing to excite people. You have to justify it, and you have to justify to these boring accountants that use spreadsheets. So what we try to
Yeah.
do is make sure we're building into this report. For the layperson, they look at it and go, wow, that's thorough. They don't understand any of the numbers anyway, but they just think it's thorough. And the accountants can actually, if they want to, recreate our model.
Yeah.
We've even had situations where under the right circumstances, we've given our model to the investor so they could actually check the calculations. We don't necessarily offer that, but in the right circumstances, we can be flexible with that. We don't want other accountants stealing our intellectual property. But if
Oh, okay.
if it's one of those things
Not
where
like
there
an
are,
industry standard kind of model?
yeah, well, at the end of the day, we build these models pretty much from scratch for each business. Um,
Okay.
you'll see when I actually show you some of these variables while we do that. So, at the end of the day, anyone that's using this benchmark, this kind of technology business or any technology business or a technology business that's a content business that has these multiples and these benchmarks and these rules of thumb. And as soon as you start hearing that, I just hear lazy, 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 lazy. Because that's not what investors do. Investors want to know, show me the money. So I'll show you a quick little demonstration I do when I'm running face-to-face seminars with people, just to get your head in the right space about value. Because people get confused about what is a valuation. So just bear with me for a couple of slides here. So we have this question, and I'm showing this, and if this is live audience, I pass the $100 note around. I ask everybody what's it worth. So I'll ask you the same question. So what is this $100 note worth to you right
I
now?
guess it's either with $100 or some
Yeah.
pixels on the screen.
So, assuming it's a real $100 note, we're face to face, and I hand it to you, you've verified it's not not counterfeit. It's $100. Okay, so we all agree it's $100.
Uh-huh.
All right? So it can be worth nothing else, or can it? What if you actually had to come and get this $100? So it's here on my desk on the East Coast. What's this worth to you? What would you pay for this $100 note?
Obviously, it's a liability then.
Yeah, you'd pay nothing because it would take you too long and or it cost you too much to come and get it. So but what about if there was someone in the office next door to mine? What would they pay for it? Probably still $100 or close to it.
Mm.
So the circumstances of the buyer, or from the perspective of the investor, it changes the valuation dramatically. So can you look at the value of something without considering the investor's situation? No, because we've just agreed here that it's worth $100. In the same breath, we've also agreed it's worth nothing, depending on whose perspective. So do you think it's important that if we're writing a report, we consider who the buyer might be? Because it's the value to them that actually matters, not the value to anybody else. So what if there was a $5 transaction fee? Let's assume you were just next door to me and there was a $5 purchase fee. Would you pay $100 for this $100 note? No, you'd pay no more than $95.
Mm.
So when buying businesses, you have advisor fees, you might have stamp duties, you might have other fees, other legal fees. Right? So again, things that are sort of unavoidable costs or time costs involved in the due diligence or the purchase process or the post-purchase process will change how much someone will be willing to spend. So if someone
comes in buying or selling?
well, here's the next question. What if the seller had to pay the transaction fee?
Yeah.
Would the purchaser care? No, they wouldn't care. They wouldn't care but would the seller care? Well, yeah, the seller might want to now charge 105 if they still need to net 100. So whether there's fees or time imposts on the purchase process and whether that's borne on the purchaser or the seller or both is going to determine how both see it.
Yeah.
So this is where it starts becoming interesting. What if I give you the note now? So you're next door, I give it to you. No transaction fees or anything like that, but you can't do anything with it for a whole year. So you've basically got to put it in your safe, and you can't spend it, invest it, do anything with it for a whole year. Would you pay $100 for it today?
No.
You'd rather pay $100 for a $100 note you can spend, because then you can get the benefit of that $100 by enjoying what you spend the money on or investing it for a year, and maybe it might be worth $110 next year.
Yeah.
So the longer between now and when you get the benefits of that investment, the less it's worth today, even though the figure hasn't changed.
Yeah.
So if you had a business that's going to make $100,000 profit this year, or it's going to make $100,000 in 5 years from now, and both are certain, you're going to pay more for the one that's going to produce the profits earlier. So the
Mm.
time value of money is absolutely critical. It's not the quantum of how much profit, but when. So what if I promise to keep it safe for you and give it to you in a year from now? So you don't even get it now. I'm going to keep it here in my safe and give it to you in a year. Would you pay the same as if you got to keep it yourself? The answer is you'd probably pay less because there's uncertainty about am I going to lose it?
Yeah.
Is my office going to burn down? Am I going to run, I'm going to run out of town and take your $100 note after you paid for it? Wouldn't you
Yep.
want to
Yep.
know more about me? So if you're buying in this process, you'd want to do your due diligence on me. Do I have a criminal
Yeah.
record? Can you find other people I've done this for and actually, did I give them the $100 note at the end of the year?
Yeah.
So again, a lot of these things are about risk. So if you did a check on me and it turned out I was actually a convicted criminal and I'd been running these scams before, you might only pay $1 for this right. You might still have a go, but you might, on the off chance I do actually give you the $100, but you might only pay $1 for it. Where
Yeah.
if I had a really good track record and I, had good references from lawyers and judges and whoever else, you might pay $90 for that.
Mm.
So it's not even about the face value of the dollar or the notes or the forecast in your business. It's about sometimes can we trust that the founders in your situation, and can we trust that those forecasts are reliable? It's not just the
Yeah.
dollars on the spreadsheet. So another level here. So what if I promise to give you $100 in a year from now, but I don't have it yet? So not only am I going to hang on to it and put it in my safe, I don't even have it. But I've got an
Mm.
existing business and my business made $100 each of the last 3 years. So it's as good as certain. How much would you pay to get a $100 note? So now you've got to trust that this business that I've got is going to produce another $100 by this time next year so I can give it to you.
Mm.
So we've added an element of business risk now. Not only it's about not about just can you trust me, but can you trust my business? And just because it's made $100 the last 3 years, does that mean that it's going to make $100 next year? A lot of valuers will think so. They'll think average last 3 years, and that's what it'll make next year. Rubbish. What if I've actually shut my business down this year? What if I've lost my key customer? What if a competitor's come and taken over my region since last year?
Yep.
Wouldn't you want to know those things?
Of course. Yeah.
So again, just looking at what the business has done and the business plan it's not enough. You need to do due diligence on what's going to happen. You'd want to know what's likely to happen next year.
Yeah.
So what if I promise to give you $100 a year from now, but I don't have it yet? I'm about to start a business. So I haven't even started yet. And my business plan says I'll make $100 this year. What would you
Mm.
pay for the $100 note? So I haven't even started yet, but I've got a business plan saying I'll probably make 100. Would you
Yeah.
pay more or
Probably
less
not.
than the business that had been making 100?
Of course. Right.
Yeah, because you're just going off a business plan. Who knows? There's no way of knowing whether this founder can actually implement the business plan, whether
Right.
customers will be up for it to pay the amount of money they're asking for that value they're trying to provide in that service or product. Okay, so you
Yeah.
might pay as low as $50 or $40 or $10. With the
Yeah.
existing business, you might have maybe paid 70 or 80. You still want a discount, but
Yeah.
so it depends. So what would you want to see? Well, show me the business plan.
Exactly right.
Show me your forecasts. Where have you got those numbers from? So you've said you're going to pick up X amount of clients the first year. How do you know? You're only guessing, but where are you getting those guessings from? The detail matters. Now, this is the most important bit. This is how we value business. So you can have all of my next year's profits, and it's not capped at $100. Here is my business plan. I plan to make more than 1,000 next year. I'm so excited. Just put that in there because everyone is. What would you pay for next year's profits? So it's not capped. You get all the profits. Again, you
Yeah.
want to know what are those profits going to be.
What about the profit? Yeah.
But it's not capped. So no longer are we talking about how much are we discounting the $100 by. This could be worth more than $100.
Mm.
And then the final slide here, I'm not just going to give you next year's profit. I'm going to give you every year's profit. My business plan says I'm going to make about 1,000. I expect to grow 20% per annum each year indefinitely. I'm so excited still. What would you pay to get all of the future profits? And this is what a business valuation is for a startup. So I've taken you through all those concepts about just because the numbers on a page doesn't mean it's worth that because of costs and uncertainties and risks and trust and doing your due diligence and things changing from past to future and are forecast believable? Is a business plan believable? Can the founders actually implement it? And now we're talking about, okay, you get all of the future profits based on what you expect expect them to be. Based, we're saying we think it's $1,000 at least plus 20% growth every year forever. What would you pay for that? And that's what we do as a business valuer. We estimate those future profits year by year, sometimes out as far as 20 years.
Yeah.
And we say, what would an investor pay today, knowing that we're going to take it with a grain of salt because we don't necessarily trust the founders telling us the truth. We're going to see what we think we're comfortable with those forecasts, potentially with a few different scenarios to give us some sensitivity around some key variables. And at the end of the day, we're going to come back and reduce that all for risk. We're going to take into account the profits that are more recent in terms of the more immediate profits we're going to pay more for than the further out profits because of the time value of money. We'd rather get the profits earlier because we can reinvest those profits or, just do whatever, spend it on a holiday, etc. So I've introduced all of the main concepts into this really simple example. I hope that you can sort of see my headspace when I'm going through the valuation process. So then that's what we need to do. So when we're looking at what makes something worth something, we're looking at value in use or value in ownership. Is someone buying your technology or business to use it in terms of incorporating it into their own business, or are they buying it purely in ownership and just getting dividends? What is the value to you, as the founder or to somebody else? Should we be looking at a particular investor's point of view or a nameless, faceless mass of hypothetical investors on average? Return on investment is important. All they really care about is not about the shiny bells and whistles and all that kind of stuff. All a real investor cares about is I'm putting money down to get something back. Don't tell them necessarily about the features of the software. What are you asking them to put down, and what are you hoping that that they get back? That's all that matters. Understanding and explaining the risk-return relationship. The more risk, the more return they need, unless they'll pay for any given level of profits. And understanding the time value of money. So I won't go into any further examples that I normally would. So just to give you, so I hope that's helpful in terms of context. So when someone comes out and says, oh, your business is, and they use some of those, online models where they go, look at your run rate, as they call it, and all this kind of stuff, and look at how many eyeballs you've got to your web page, like that matters. They'll look at, on a particular industry, pull out a benchmark of your expected growth rate, and then work out if you're, what your value per user is, and they start working out, each user is worth $0.001 in terms of value of your company, blah, blah, blah. And it's all rubbish. I laugh when I see that kind of stuff because I say, well, is this business even going to make a profit with all its users? Are these eyeballs actually going to be profitable eyeballs? And I want to know what are the mechanisms the business is using to turn eyeballs into money, depending on the business model. What is the model? What is the model to generate money? And even things like Twitter and LinkedIn and Instagram that weren't making money when they sold, people then therefore think that's a license to say, I don't need to have a profitable business to be selling. And if it's in the tech space, that's rubbish, because what Facebook's looked at when they bought Instagram is not what money Instagram's going to make for them, but what money Facebook is protecting, because they no longer have a competitor that may take money off Facebook.
Right.
They are still doing a discount cash flow forecast looking forward, but they're looking at incremental differences in Facebook's profits.
Yeah.
They're saying if Instagram's around and takes market share from Facebook, Facebook's forecast and therefore Facebook's value comes down. So they're doing it one of these models, and they're seeing that their revenues and cash flows are going down, which decreases their value. So they're basically saying by acquiring Instagram and making sure it can't compete, Facebook's future forecasts then go back up, which they have then effectively added extra value to their own business by cutting out a competitor.
Right.
But, understand that they're still doing, whether they're explicitly doing or it's just happening intuitively, they are still doing a discount cash flow over the life of their business and looking what are the incremental cash flow differences to work out what are the changes in value. They're not saying Instagram's worth $1 billion because it's got so many users. They're saying it's saving us or making us X amount of dollars per year, therefore we'll pay a certain amount to have the right to that incremental benefit.
Yeah.
LinkedIn's the same, didn't have a way to monetize. A lot of people say, oh, we'll work it out later, but whoever, when they list on the stock exchange, the investors are reading through the prospectus and seeing how the directors are planning to monetize, and they're doing their own little mini discount cash flow models in their own head, whether they realize it or not, saying, well, if it does monetize that way and you've got all these advertising opportunities, blah, 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 then maybe it is worth $1 billion in today's dollars. There's always got
Mm.
to be a financial outcome. Whether people realise it or not, that's what's actually happening. Which again, people think they see these businesses listed with no revenue and they think that's a license to say that it's all about being sexy and having the most number of free users, right? It may be that's a means to an end, but it still has to come down to, if you're asking serious money, you have to prove to those parties that you're going to save or make them money, one way or
Yep,
the
yep,
other.
yep. Considering
So,
the amount of costs involved, obviously there's valuation, there's negotiation, there's the accountant fees to set the structure up, there's the lawyer fees to make sure the paperwork's up to scratch. I don't know if there's any stamp duty fees involved. Considering all those
yeah.
costs I would imagine add up to 50 odd thousand. How does a new startup go about funding a seed round if it's that expensive?
They either get, and I've wrote an article on this recently, or comment on someone else's LinkedIn article, and basically they beg, borrow and steal. They stage it, so MVP also applies to your raising a capital process. So you look at what's the first step. Do the first step as cheap as you possibly can, and then the second step should reveal itself. So I've talked to other colleagues, and as I do at conferences, and I'll talk about situations like the one I've got in front of us here, where I value this manufacturing product business, and to be honest, I charge $10,000 to do this whole process, and I talked to other valuers that were basically doing the same thing I did, and they all of them said they wouldn't touch it with under less than 100,000.
Yep.
And so there's this huge discrepancy about what our industry actually thinks this kind of service is worth. These other firms aren't necessarily doing anything beyond what I'm doing here. They're not going negotiating or writing business plans or anything like that. They're just to this part of it, and they don't generally value startups because they can't find a startup that will pay the money. Right? So they've got this hypothetical thing of what they would do with a startup, but none of them seem to actually get any business anyway. It's all just it's all in their business plan that doesn't get implemented because no one takes it up. What often happens is that you have got to do such a song and a dance that you get someone with money to believe in it, despite having no numbers. So, and often that's family members and colleagues, or potentially a competitor that gets some kind of early access to the technology or some kind of joint venture arrangement. You might find there's a joint venture partner that you have to sell a bit of your soul to, and that's the problem. I've got a software startup myself, and we're talking to investors, and the problem is you can find venture capitalists, but they want everything for nothing. And people always say this story about, I've raised $1 million for my business. They don't tell you that they had to hand over 95% of the shares to do it, and we're working on a minimum salary for the next 5 years.
Yeah.
As part of the deal. That you don't hear all the terms and conditions of the deal. All you see is something on TechCrunch or on news.com.au saying that they've raised $1 million for their business.
Right.
So these angels aren't really angels. They come along and they want everything, and why wouldn't they? They're in a position of power. Why not ask for everything? And if the founder's down to the last option, they'll probably give everything just to give their little baby a chance at life. So this is your problem. When you've got almost nothing to sell, you're on a big disadvantage, and you don't. We had this debate on LinkedIn yesterday about, well, is it the government's responsibility? Is there a social responsibility to fund all of these businesses just in case one of them goes on and employs 1,000 people, which then helps everybody? The problem is this. I'm trying to contend to people is how do you know which ones to? We only want to back winners. How do we know which ones to back? Investors and the government, we can't afford to back ones that aren't going to win. And it's almost impossible to tell before the business starts making profits which ones will make profits and which ones don't.
Yeah.
We can't afford to fund all of them, so there needs to be a process of survival of the fittest. Or gets really, really lucky of doing a song and a dance and having someone believe in the product as much as you and they've got money.
Yep.
So what we try to do, what we say to people is where we can come in, and this is where I'm saying you don't need a full valuation. I wouldn't let you get a full valuation from us at this stage. What you need is something that gives your business a bit of credibility, so that when you start having these conversations with people with money, you can give them something from a third party so it's just not another founder getting all excited about their business plan. Right? And so what we would do, we'd give you some kind of document that you would use as a third party, not proof, but a third party discussion paper or a set of hypothetical calculations. So what I would probably suggest to a business in your situation is probably building this kind of model you can see on the screen now. So you should see Excel. And what we do, what we're trying to get to is, if I go here and there's one for each scenario, what you're seeing here is a discounted cash flow model, which actually, I'll just make it a little bit bigger. It'd be hard to see the numbers, but you can see it goes out about 20 years. I'll make it bigger again so you can see some of the numbers. What we're trying to do is we're trying to predict. So let's look at next year. So 2014, there's nothing happening, all zeros. 2015, we're predicting sales at this number, 4.5 million. Cost of goods sold, in this case, it's production costs of 2.9, gives us gross profit of 1.6. Overheads are 3.2. A couple of other little adjustments here. We actually come out with net cash flow of minus 1.6 million. And those variables change over time as the business grows and the cost structure changes and economies of scale. And so the next year, which is 2016, it's 642,000 positive, 1.3, 1.7, and it goes out to the point where by year 20, under the first set of assumptions, the profit's actually $81 million. What you're seeing here is the cash flow valuation model that gets its numbers from the variables page. All right, so these are results. Nothing happens in here other than displaying how those variables turn into a cash flow. And what happens here, there's a thing down the bottom here called a discounting. So what we do, remember, each dollar in the future is worth less today because in the meantime I could have invested that money. So what happens is that there's a bit of a factor here which is built up. I won't go into it today, but we look at all the risks and we come up with a factor. The higher the risks, the higher we'll penalise each year's profit for risk and time value. So what we do is we convert each year's into a today's figure. So the 642,000 next year is only worth 401 today's figures. The 1.3 million the year after is only worth 611. So they become progressively less and less to the point where that $81 million is actually only worth $181,000 today. Because there's such a huge risk that it's not going to happen and the time value of money. So what actually happens, each year contributes to the value, and then there's this cumulative thing that happens in this row here that keeps adding them up, and it adds also this what we call a perpetuity terminal value. It actually then looks at not just those 20 years, but the 21st year and beyond at a stable growth rate, and actually adds on, in this case, another 554 for all of that. So it's not just the 20 years, but the fact is after 20 years, the discounting becomes so high that it's almost irrelevant. We add that on anyway. And that's where we get the $8 million. It's the sum of all those discounted cash flows.
Yeah.
Okay. So where we get those figures from, so again, this is really just a result spreadsheet. In here, we also do some sensitivities saying that the discount rate in all of that is 36%, and that we do some sensitivity and so this is all about risk and time value. If the discount rate was slightly higher, 37.5%, it would actually be a lower valuation because there's more risk. If we could prove the discount rate was 25%, and it'd be pretty hard for a startup, you'd have to have some really good proof that the variables are going to happen, then your valuation is actually $26 million, which is a huge difference. So what you can see from that, it's not just convincing people about the future profits. Risk is a major factor in a discount cash flow valuation because the risk will determine the discount rate, which will determine the multiple effectively.
Yeah.
So again, anybody that says, oh, what's your future profit going to be? Multiply that by a number, there's the value of your business. Ridiculous. Doesn't take into account risk, doesn't take into account the time value of money, doesn't take into account the sensitivity of each key variable. Fine, use an online thing and get some advice about benchmarks, but it's never going to be enough for anybody to rely upon.
Right.
So where these numbers come from is in our forecast. So what we do is we build a model with as many variables as we need to, and we work out. So in this case here, the key thing that mattered was how many of these units he's actually going to sell them in hospitals in different parts of the world. And the key thing was actually how many hospitals are there in each part of the world. So he provided data to us on the US, Germany, France, UK, and the rest of Europe. Yeah. And we actually plugged in these blue cells here how many hospitals there actually were based on their Bureau of Statistics data in each country. We're trying to work out how many units would we sell to each hospital. And it worked out. We're doing that on the basis of a saturation rate. We're trying to get to a point where eventually they thought there'd be, for every 200 beds, there'd be one unit sold after 20 years. And so he's sort of working out what are our metrics, what are our underlying assumptions, and then we're building out, well, that's going to happen in 20 years' time. We'll have that saturation. How will that develop over time?
Yeah.
And we're sort of building into it, sort of the growth in units sold. So we're trying to get to a point where this is telling us how many units being sold. That's all. Here we're not talking about price, just how many units sold. We did that for each region of the world. Again, how do we know that's right? We don't. It's just best guesstimates. And we just then have to prove, or the founder has to prove to the investor that those guesstimates are accurate enough to rely upon. Now, we look at it for, does it look reasonable? But we don't assure anybody that they're correct. Nobody does. It's about convincing people to make, do their own testing and work out if they believe it. So we also did the same for chiropractors, osteos, physios, and nursing homes who would also use these machines. So we're basically looking across all hospitals and second-tier health providers. How many of those machines could we sell to those people based on their needs in terms of how many customers they would need to use it? All best guesses, but educated guesses. We then build into that sale price. So what's happening is that each year we've picked a starting sale price and just grown it by inflation. So each year has got a different sale price. We could have made it more complex, saying that the sale price will go up or down over time based on whatever, but we've just kept it really simple here and just set up by inflation. You could factor in that as that gets more saturated, you might have to drop the price, or as more competitors come in, you might need to. So it would depend on your strength of your patent, whether other competitors could come in. But, all that kind of stuff could be built in. Here it was overkill. We just kept it simple. And then we're looking at assumptions. So in this case here, pretty simple, manufacturing cost per unit. We know how many units we have to produce to sell because we've already worked that out above. We then work out what's it going to cost, and we factored in some economies of scale. So costs actually come down by 2%. As basically they're producing more mass of product. Then we're looking at labour costs for the factory generally, freight costs because we have to send these things to the customers, and then we looked at this person had to actually invest in startup costs like tooling up and construction of the factory and all that kind of stuff. That was yet to be paid for, so that had to be factored in that the investor's going to cop a negative revenue for that, and that's why in the first year they've actually got a negative cash flow. And that's all factored in, so we're not hiding from that. We're factoring in those negative cash flows and building them into the whole valuation. So the business is worth less because the founder the investor has to invest cash initially. That's already factored in at the best guesstimates of what the initial outlay is going to have to be.
Yeah.
So then we look at all things anything we can think of. So we're probably going to have to use sale agents to sell these machines. On average, you might pay them 5% commission. Who knows? Put a number in. And we're going to have to spend money basically administrating the business, assuming that the buyer doesn't already have a huge infrastructure administration. And we've used just a basic estimate, looking at benchmarks across different industries, and we've said about 20% of revenue will be about enough, and that'll grow by about 1% as basically the business gets more bureaucratic and bloated. It already grows for inflation because it's a percentage of revenue, and the revenue's already going on inflation, so we don't need to inflate this percentage for inflation as well. And then we've got other general fixed costs that it takes to run a business. And again, we're just trying to actually be fairly conservative in the costs and put as many costs in as we can think so that the purchaser and the accountant don't look at it and go, oh, but they haven't factored in X, Y, Z and overheads and payroll and blah, blah, blah. We want them to look at it and go, you know what, they have factored those things in. And there's still a good, nice valuation at the end of it. So we're trying to basically defend those carte blanche statements by the value of, oh, but they didn't even take into account X, Y, Z. We're trying to factor in as many logical things so that they, again, all this report's doing at this stage is to give what you're saying a bit of credibility and showing that you're not just being one of those excited founders that thinks you're worth $1 billion without trying to have to prove it.
No,
We're just trying to give it some third-party credibility. I think, again, I would do a stage process. I would say I think it's important that that if we built the variables about what you expect now in the business, so look at your business plan, and what we actually have is we have a comprehensive questionnaire, which is part of this process. We would give you this questionnaire, and in that would be things that you'd never even thought about for your business that are critical. And part of that process is to make sure that you are thinking about, if not already, you start thinking about the things that make a difference. So there's value in just going through that process of completing the questionnaire and providing us the you know, trying to convince us it's worth a lot, showing us the business plan, any systems, procedures, all that kind of stuff. We want to see everything, and then come up with at least one scenario based around the current business plan on how you intend to grow, and just to see what might the model look like. Not necessarily to show to anybody, but you might. And you would cut out, so where our cost is in our labour. So when we have to do many scenarios and justify them and write a big long report, that's where the labour is. And that's why our fees are relatively high for the report. To just do the calculation, so basically the process would be, we would give you a simple proposal that you would agree to. We would give you the questionnaire to gather the information for us to understand everything, which would give you an opportunity to actually ask yourself questions you probably haven't asked yourself. Provide us with as much of the technology as you're comfortable. You can have us sign any confidentiality agreement you want us to. That's always assured. We would then create the model, have a bit of to and fro if we needed to help understand the business better, to create the model, then come back to you just with these calculations for at least one scenario. So build these forecasts over probably a 20-year period, build the discount cash flow model, basically look at how sales are growing, look at how the profits are growing, and come up with, therefore, what is that magical value right now. And that doesn't have to be expensive, because it doesn't have all the labour of the double checking and the convincing and the writing of the report. The benefit of that is if you then wanted to do more, we've already done that part of the work. We've already built the model. After that, we're probably just changing the variables or writing reports and that kind of stuff. So it wouldn't be a wasted cost. It'd be probably fully rebated against anything else you did. It wouldn't be wasted if the result of going through the process forced you to think about the business and therefore the variables change. I would be seeing, like, I deal with a lot of startups, and like I said, I've got my own on the side as well, and I think the most valuable thing that would come out of this from you is having an independent person scrutinise your business, so that you think about it differently, which I guarantee you'll change the way you're planning to run this business because of the result of this process. I guarantee that reading our questionnaire and completing it will change the way you think about your business. That's a guarantee. Regardless of what the valuation outcome is, you will change the way that you do things because of that process. It's the same when we value anybody's business, even an existing business. We'll do a valuation and we'll point out critical things that are good, bad, or indifferent in their business, and they always go and change things about their business. Because it's often the first time they've actually had someone without any incentive. So I've got no incentive to tell you it's worth a lot. I'm not a broker trying to convince you to list it with me for sale. I'm not trying to invest in it myself. I don't care what the outcome is. All I'm trying to do is give you holistic sort of independent advice, warts and all, about what I really think. And I'm probably going to be the first person that's ever done that with this business. Because I'm not your current accountant. I don't care about whether you keep doing accounting work with me or not. I don't have any reason not to give you the best, most accurate advice. I've got no secondary purpose here. So often it's just the fact you've then got some critical person like me trying to simulate what a purchaser's value will do, so at least it gives you a situation to understand where things are, potentially change things, and also be in a better position to have conversations about what are the key things and know what those key levers and dials are going to be to if you are talking to people, the kind of things you would emphasise to them right now, not necessarily later, but the kind of things that if we point out there's certain things that are going to make this, be make or break for this business, you need to make sure you've got those things sorted, and they're the things you're pitching to people. Right. What are the critical success factors in this business financially? If you can convince people that you've got those things sorted, that's going to do a hell of a lot of work to convince people this is a good investment, as opposed to concentrating on things that might be nice to have, things that don't necessarily make a material difference. So I think I would see this more of a process than an outcome at this stage. When you get if you ever decide to go ahead and get a full report that you want to show people and show their accountants to rely upon, that's different. That is an outcome in of itself. But I think at this stage, the process is as important or more important than the outcome, is my opinion. So I think that's the decision you and the other founders have to think about is it worth investing to go through the process and put the business through the ringer and ask yourself the tough questions and have have me give it some feedback. And at the end of that process, I'm more than happy to have a hookup and actually go through, in terms of business planning, the kind of things that I'd probably change in the business.
Mm.
I'm going to be in a pretty damn good position to give it advice and that's not necessarily any extra cost. I'm happy to give some limited advice there for no cost because I'll be in a position to do it.
Right.
Because part of what I do is I actually not just value businesses but give them strategic advice and how to grow. So I'm not going to be able to help but have ideas.
Mm.
And I might say your plan is perfect. I probably won't, but I might just reassure that what you're doing is on the right track, and that's going to give you peace of mind as well. So don't have to decide anything
Mm.
now. I'll make this recording available to you. I'll email you a
Yep.
proposal of what that kind of service would look like, what the terms and conditions would be, and then just have a sleep on it, have a
Sure.
think about it. At the end of the day, the more that you can make sure you're on the right track and be able to articulate to others, whether that's with an independent report or not, the more confident you're going to be when you do negotiate.
Yep.
So you know how much ground to give and you know what kind of things to emphasise.
Right. Yep.
And your confidence. And at the end of the day, with any negotiating, if you're reading any negotiating books or following anyone that does it, it's all about that confidence. If you don't have the
Yep.
confidence of what you're pitching, you're going to get eaten alive, especially by professional investors.